One of the things that's happening, though, in the small business world, and I talked to quite a few of those people, is that their costs have gone up, their prices they're having to pay labor has gone up, but yet they can't push it out. They say, if I push those prices on out to the public, my business will go down. So they're sort of stuck in the middle on this thing. And then they worry a bit about it because they don't really know from the standpoint of which way the country goes and what happens in all these elections. I think that throws them a little bit. But generally, they're getting squeezed. And I think that's why they have the outlook they have. I think they've continued to borrow to make ends meet and to buy what they want to buy. And we haven't gone through a period yet where people will say, I just can't do that anymore. But if you look at the number of delinquent credit card accounts that have been closed, in other words, we're not going to give you any more credit, that's gone up quite a bit. And so you're seeing what's happening is people are starting to borrow more to live and to do the things they want to do instead of trying to really live within their means and cut back. I think a lot of them are having to borrow just to do the normal rate of business week to week. And that's why it's going up, in my opinion. I don't think they're paying for cash. Even if they're using a credit card, they're not paying it off. The credit card rates now 28.9, 29.1. I've seen a number of them like that. And if you think about that, that is an egregious amount to charge to the people. They always make a mistake. That's nothing new. I mean, if you go back over 30 years, really, from Greenspan on, they do nothing but make mistakes. All you have to do is go back and look at transitory inflation, and then they thought that wasn't going to last, and they raised the rates too much, and now they haven't lowered them fast enough. And now I think what they'll have to do, because the government has so much debt, is have to lower them lower than they think, which is going to create another inflationary spiral. So they're between a rock and a hard place, and I don't think they have the skill set to know what to do with that. I think they think that, hey, the Fed's going to come to the rescue here. Rates are going to go down. We're going to go back. Happy days are here again. And I think they're forgetting that, you're in a period now, and this doesn't make sense, by the way, for the Fed to be too aggressive on the downside when you're running huge deficits at a time when the economy's really doing okay. I don't know if that was political or where they were coming from particularly, but I think one of the problems they'll run into is if you start showing 3 or 4 months of inflation here, and they've already told the world, hey, we're going to move the rates down, and then they're stuck. See, they're like, okay, no, we're not going to do that. Then you send, again, after many other times they've done this, you send the wrong message to the people out there. And so, they've gone out and bought long bonds, and then all of a sudden they may not work. The thing about the Fed is one of their jobs is make sure the Treasury makes it. And the Treasury's been basically doing nothing but T-bills because they know that's where they can get the financing right now, because so many hedge funds and short-term people will buy the T-bill when they won't buy a long bond. That's why we have all this T-bill issuance that's going on. And the Fed itself, the problem for them is they realize that this debt load we have right now is drowning the government. So they have two choices. They can either decide to keep the rates high and make things go austere, which the economy would break, and here they would come with low rates again, which wouldn't work. Or they can lower the rates lower than the inflation rate, which would happen, and then all of a sudden you're into stagflation, which is the way we think they will go. It may not necessarily go back to the lows, but you could see them run 3% Fed funds rate or something, and inflation be at 4.5%. And that's the way I think they get out of the mix. But it takes a lot of years to do that. What I'm saying is, no matter where the rates are, I suspect that they'll be lower than the rate of inflation. And so what would happen is it wouldn't make any difference if they were cheap, because you could have cheap rates, but your inflation's killing you on the other side. I think what people don't realize is that if you look debt this year, the cost, just the interest on the debt this year is more than we're spending on defense. Well, somewhere in here, you have to say, okay, we've got to take care of these people that are using all this money in deficit spending. And so I suspect that's what's going to happen. It won't be good, by the way. If you're pushing the rates down and inflation doesn't come down with it. Now, maybe it does for a while, but in the long run, I don't think it does. But see, we're at a point now, and it's critical. You're such a point now. It's not like it was before when you were running at 40% debt to GDP. Your numbers now are so high that when you run that number through, that it creates a quicker turn of inflation coming out of it. So that's why we felt like this next decade would be a decade where commodities and things like that would probably would fit more. You'll own other things too, but I think people have to realize that you've got to have some sort of hedge against it. the exposure to the stock market is, as a percentage of financial assets for everybody that invests, is the highest that I've ever seen it, and the numbers I ever had. I don't have a number this high, and it is extraordinarily high for people over 65. For people over 60, 65, they have about 2/3 of their exposure of financial assets to the stock market. And that tells me that everybody, including that boomer group, are very, very complacent, as if nothing, they don't realize they're in a risk asset. The stock market's a risk asset. They don't realize they're in that. And I think anything that rubs the wrong way on that stuff, and you're going to have some serious problems for that group, because they're just too exposed. Because what happens is they've all bought all the way, and they have everybody's in. And so, the cash levels, if you look at cash levels, they're low too. And bond levels are really low, but they've decided that, nothing will happen. We have short memories, so let's just put everything in. We just keep on buying, and that's the way it goes. I mentioned the other day, it's like you're a football team and you're ready to score an extra point, and you decide to go for 2, and there's only 3 seconds left. Well, that's what you're doing right now. And a lot of them are going for 2. And a lot of times you don't make it and you lose the game. And I think that's where we are right now. They're assuming that everything's going to be okay, not realizing that, if it goes against you here, it may not be so great. Well, I think the biggest one is if all of these countries decide, and it looks like they are, starting with China, and then they've just now had the ECB, everybody decides we're going to lower rates and we're going to really get this thing going. Well, it's already going, because they're all running deficits already. So for them to decide that, hey, we're going to try to juice the system now, it's not time for that. What that will mean is that real assets will probably be the place where it will catch that on the upside. I think financial assets, people don't realize this, but when you go into inflationary times, and you may not eventually, the first 6 or 8 months, you may have rates go really low because we get in trouble here. But I'm just saying eventually they come back, and we're at a time when you get debt levels this high, that means you don't have any room to move. You can't maneuver anything. And that's where we are as a country right now. We're not going to go austere. You can bet on that. So the only way for them to come through it or get out of it is really keep the rates lower, which means you're probably going to need some real assets along with those financial assets. Well, real estate's certainly one. I think real estate's a great investment, and I've had it and done it and own it for sure. But for us too, in addition to that, we own energy, we own natural gas, we own oil, we own fertilizer, we own a lot of the metals, we own a lot of gold and gold miners relative to what we've owned in the last 20 years. And so our percentages are fairly high in that right now. So that's where we get that exposure. For fertilizer, first of all, the input to fertilizer is a commodity, and typically it's going to be nitrogen, natural gas. A lot of that fits in the input. On the output for fertilizer are obviously, grains, all kind of soft commodities, but that all comes through fertilizer. So you pick it up on the other side as well. You have a bigger demand for it. The utilities, I think the change there is the business model is changing. If you look at the amount of electricity that's going to be needed, we haven't owned utilities. We've owned them in the last 18 months, 2 years. But before that, we hadn't owned any in a long, long time. But what's happening is you're going to have big demand for electricity, and we haven't really set up for it in this country. All of our nuclear is really old and dilapidated. They're trying to get some small nuclear going for corporations, but we haven't let them build new plants. A lot of things go on, and so they're going to be a lot of pressure on the grid. And I think utilities will be more of a growth industry going forward, because all of the things that are producing now are productive. AI, data centers, any of that sort of thing, even Bitcoin miners, all of that takes a lot of energy, and you're going to have to fund it some way or another. And we think it'll be natural gas, but that's just our opinion. If you look at gold, in the long run, gold goes up. In the long run. And you'll go through 4 or 5 year periods, sometimes 6 years, where it doesn't go anywhere. In fact, it falls off some, and people lose faith in it, and it comes back and goes to new highs. But I think this time around, because of what the U.S. has done, people want to get away from the dollar. And if you're going to own anything, you've got to own gold as a hedge against the dollar, number one, but what's going to happen, because they're buying gold. They do not want, if you go look at the amount of Treasury securities they own now, it keeps going lower and lower and lower since 2013. And so you want to be side by side by those other countries that are buying gold. And I think that's where people probably make an error. They don't realize, well, they say, and all I'm saying is you need to have enough to where as prices move forward, and you have inflation, you have things turn around, gold will stay up with that over time. It may not month to month, but it'll stay up over time. with these 40 years of lower interest rates, everything became financialized. In other words, everything's finance. If you look at everything that goes on, it's money. Money this, money that. And every time you had lower rates over that 40-year period, people kept financing, refinancing, pushing up prices. Everything had to do, though, with the cost of money that was so cheap, and it got cheaper all along. Okay, the game's changing now. And so you're going the other way. And if you go back and look, say 1963 or 4 up through about 1982 and 83, it's a very similar look. We had trouble with the debt, and it went into a period where the commodities outperformed because your inflation rate was running so high that financial assets weren't doing the trick for you. You had to have something else to add in with them. One of the things you have to keep in mind, we have no idea what will happen in the Mideast with those two situations, but either one of those could cause you to be in a situation where oil gets in a situation where it's really in big demand, but there's no supply. And I think it does okay either way, but that's just something that you have to be on the lookout for, because if that happened, you need to have some oil. One of the drivers to bring it off was, we got up to $120, and I remember back, over the years, when it's up high, you always have the people that think, hey, it's going to 200, 250. It never does. It's always at the top. And unfortunately for oil and gas producers, they're not good themselves at knowing when to cut back and when to add on. When things are really hot in the oil market, they just bring more on. And they sort of kill their own supply. In other words, they bring their supply too much. But over this period of time right here, the demand's been good. Worldwide demand's been okay. And, we've been able to produce a lot more in this country as well. So I feel good about this country for sure. The first year of a new presidential 4-year term is the worst one. And I think people that don't realize that no matter who comes in, the first year is a hard year in the markets that they are. And people get confused. They think, one or the other is a panacea. When if you look at the policies, they both want to spend a lot more money, cut a lot of things, do a lot of giveaways but when you give away things, you cut the revenue. And when you cut the revenue, that means you got to run a bigger deficit. And you will get to a point. There's, I don't know when that is, but you will get to a point someday where the countries say, we're not buying your bonds. You're already buying less, but we're not going to buy any, because you've just run yourself into a hole here. And that might not be for 5-10 years. I don't know. But every little bit of that hurts you as a country eventually. And that, I think, for us to not realize that. When's the last time you heard either one of these parties talk about, let's balance the budget? You tell me. It's been so long, it's incredible. And all the congressmen, they do the same thing.